I'd
Okay,
like to call to order the meeting of May 14th, 2025, of the Warwick Pension Board and ask for a roll call.
Richard Baskin.
Jim Hendrickson.
Philip Barrow,
Bob Riley.
Frank Nash.
Dave Kramer.
Chitsame Lamb.
Kevin Schmidt.
Thank you very much.
Everyone, the other couldn't take it, everything.
Whenever, yeah, I'll grab them whenever you're ready.
Okay.
Yeah.
Well, I didn't hear you.
We got one more from Cook, I said outside.
Oh, okay. Well, he can,
Yes.
he's right here now.
Yeah.
Minutes, second to the minutes. The regular meeting, April 9th.
Let's refer the minutes.
Second,
Second.
all in favor?
Aye.
Opposed? One of the things I did notice in the minutes, so they did, I think, reverse your names is who seconded.
Who seconded?
Yeah,
I think we can live with that.
Is there any public participation?
There are no hands.
If not, we're gonna move to approval of pension applications. There were three, Tina there.
Yes.
You're on mute, Tina.
Okay, I'm sorry. I was for some reason having some internet issues. I don't know what was the matter, so it took me a minute to log on. So I apologize for that. So we have three pension board pension documents. Just trying to find them. Sorry. Just give me 1 minute. I apologize for the delay. Oops, sorry, that's just the agenda.
Tina?
Yeah, I'm here. I'm sorry. I was having an issue pulling it up. I have it right now. Okay, so I apologize. So we have three pension applications today. The first one is James McGarty, who worked with the DPW. He was a maintenance mechanic. He was with the city for 35 years. He's requesting a regular pension with option 1 with a commencement date of March 1st of 2025. We also have Donald Caravan from the Board of Ed. He was a plumber. He worked with the Board of Ed for 16 years. He's requesting a regular pension with the standard option selected with a commencement date of February 4th of 2025. And lastly, we have Christine Olden from the Board of Ed. She was a special educator. She was with the Board of Ed for 27 years. She's requested a regular pension with the standard option with a commencement date of March 15th of 2025. We would request approval of all of the pension applications.
I do have a question on Donald's. He lists his son as his beneficiary. And I think one of the things we've talked about in the past is he could have had a wife, could be divorced, he could be still married, but we don't know that. And we wouldn't, if he was divorced, there might be a complication when it comes to his pension. Right? So should you, on the application for a pension, have marital status as one of the items? Because we could approve this and find out in the future that there's a divorce decree that allows his wife to get part of the pension. And we don't know that unless we know his status.
Okay. Yeah, he's a Board of Ed employee, so I'm not sure about, I don't have the access to look, but we can absolutely do that going forward. We can add, I will speak to the staff about updating the form to have marital status added to it so that going forward, we can figure that out. And, if you want to, either, if you want to table this one, then I can get that information and bring it back to you if, to confirm.
Is a motion to table that one.
Yeah, okay, I move we table that one.
Second.
I'll second that.
All in favor, aye.
So, Tina, are the teachers are on a completely separate system, but the other employees are on our city employees under our pension plan.
Correct.
So it's, but they're on a different system as well, which is why you don't have access to the data.
So, I have access to Munis, so I can look up their regular, but I don't have their, medical, tip, like for our employees, I have, we have them fill out when we onboard them. We have them complete like medical forms, waiver forms, et cetera. So I would be able to, at least going through that, be able to at least get an idea. I don't have that access to Board of Ed. I can look up the employee, but I don't have access to that. I could check to see. You want to give me 1 minute?
One other thing, I think to list like whether it's somebody's marital status, but also if they check divorced, it should perhaps say something that says the ex-spouse have access to any of the pension. I don't know, you would word it better than I would.
Yeah, there's a court order or a quadro, some type of court order giving the divorced spouse a right to some portion of the pension.
Right, and have them check yes or no, so then there's a lot,
That's right.
because then there's a liability if we don't then approve a pension that might later on, should not have been approved. Okay?
Yes, when we receive a quadro, from, prior to retirement, when we receive a quadro, we always, there's a red quadro stamp that we have that gets stamped all over the file, so we know ahead of time, but obviously, if it's post, then we don't, let me just see if I can find.
But at least on the application, if they did say yes or no to that, it might speed up you and
Well,
maybe.
we've got a case coming up later of somebody who did do something on time.
Yeah.
And somebody may not have notified the city about the existence of such an order. And then we find out about it 6 or 8 months later and messes up the payments that have already been made. So at least if we ask for it on the time of the application, we can try to head off some of that kind of problem.
So a quick review of the employee in question, at least through Munis, does indicate that the employee is married. So we should table Caravan, and I'll find out more about that.
He's married now.
I mean, that's what Munis says. I can't guarantee that, but just looking quickly, I went to demographics and actual status is, it says married, but I don't know if that's been updated. That could have been at the date of hire and it's just never been updated. I don't know that. So I will, if we table that one, I will find out and get back to you with more information.
Should we approve it pending her information?
I'd rather not.
Okay,
Suppose we find out there is something.
right,
Yeah,
right, okay.
So
this table it.
I'll make a motion to approve the other 2 pensions here.
Just a second, all in favor?
Aye.
Opposed, no, thank you very much. Gina, one last thing before you go.
I'm not leaving, I'm stay on.
Okay. I sent you an email, but it was later today in regards to the union contract. I used to have a copy of the union contract when the new contract came. I didn't get one. It's quite extensive, but in it there was a section in a paragraph that said that the pension board makes the final decision when it comes to pensions. And is that still part of the contract, do you know?
I will double check. So we're in the process of finalizing negotiations. I thought that might be in the pension document, not in the collective bargaining agreement, but I will go off. I'm going to stay on the meeting because we obviously have other things to discuss after. But I'm going to pop off. I can send you all of the collective bargaining agreements. And then at least the current ones now. I'll double check a few of them while you go on to the next thing, and I'll let you know whether it's in the CBA or in the pension document.
Okay, thank you very much.
Thank you. I'm just gonna shut my camera off while I look, but I'm here if you need me.
Thank you.
Did Pimco come in?
Yeah, I'm gonna go grab the gentleman in the.
How about that old one, where we, right, as we go, we're gonna cover that one now or no?
No, we're gonna cover that at the end.
Yeah.
Exactly.
We'll go in the executive session for that.
At City Hall, Lauren Moss from Channel 7 Eyewitness News. Taking a quick look at Wall Street, where on the next day.
I can see over down. Yeah, here, sit with this one. I'll pull one over. Yeah.
Does everyone have a copy of the materials? I brought some.
You don't, I know there, we put some in the back of our truck too, but otherwise. Yeah.
Dustin, you can hear us okay? All right, great. Well, thank you for the time this evening. Really appreciate it and the opportunity to present. By way of introduction, my name is Eric Bachman. I work on the institutional client team at PIMCO, specifically working with public pension plans. And my colleague on screen, Justin Blesi, who's based in our Newport Beach office, is a senior strategist on our product strategy team and works closely a number of our multi-asset strategies, including the all asset fund, which we're going to talk about today. Before we kick off though, I just want to thank you all for the long-term partnership. Just a few weeks ago, we hit the 20-year anniversary of managing money on behalf of the Norwalk City employees, and we, appreciate the continued trust and support. So just want to confirm we have 30 minutes.
Yes, we give you our time. We
Yeah.
give you 45.
Well, that sounds good. So I think what we'll do is provide a brief refresher of the strategy, touch on performance, positioning, outlook, and then we'll save some time for questions at the end. Before we get started though, is there any particular areas of interest or areas that you'd like us to cover?
I don't think so. I mean, some are gonna be more familiar than others, depending on their time on the board. Is that fair? So. At least,
Everybody's pretty knowledgeable on this board.
yeah, yeah.
We're a sharp group.
Always makes for more fun conversations. So I appreciate that. All right, well, with that, I will hand it over to Justin.
Great. Thanks, Eric, for the introduction. Just to check, you guys can hear me okay?
Yeah.
All right. Well, thank you. And sorry that I couldn't be there in person. My mother-in-law had a health issue, so my wife is back on the East Coast. And speaking of my wife, we actually have a personal tie to Norwalk. She spent the first year, 20 years ago, living there. So I would go from Manhattan to Norwalk every weekend. It's a lovely town. So thank you for the time. So I'm going to start with a refresher of the strategy. I know it's a sharp group, but it actually helps set up a lot of the discussion around performance and positioning. If you're following along in the book, I'm on page 6, assuming it hasn't been condensed with other books, and wanted to just remind on a few items. First is, when we think about the all asset strategy, in terms of the benefit it's designed to add to a portfolio, there's really 3 key items. One is to provide attractive long-term real returns, but to do so with equity diversification and a reflationary or an inflationary bias. The reason we emphasize those is because they're very complementary in terms of what it brings to a portfolio to what assets are typically held in terms of equities and core bonds that provide growth and some diversification, but don't necessarily provide those equity diversification and inflationary properties. And so to achieve our objectives, we tend to emphasize what we'll call throughout this presentation diversifier assets, which are the greens on the right-hand page. You can see that includes traditional inflation-related assets like TIPS, REITs, and commodities, EM debt and equity, credit strategies, as well as liquid alternatives. And given our namesake, all asset, we will use all assets, including core bonds and US and mainstream equities, but typically only when they're cheap, or in the case of core bonds, when we want some dry powder, which we'll come back to, which is something we do want today. The reason we note this is that our strategic emphasis brings different properties, both in terms of return and diversification to an overall portfolio, and do want to just kind of unpack the performance point first. So if you go to page 9, and we know that you've had a long-standing investment with us, so you've seen multiple cycles here. This is pretty instructive just to think about the performance environments that we've been in the first decade of the strategy, from about 2002 until the taper tantrum in 2013, and then what we've seen in major asset classes since 2013. And these are two very different regimes. In the 2000s, it was a period where you had two equity sell-offs, the dot-com bust at the beginning of the decade, and then the great financial crisis in 2008. You ended the decade modestly positive with a lot of volatility. Bonds throughout both decades provide stability, but not necessarily as much in the way of returns. And diversifiers were really that complementary return driver in that first decade. Now, in the last decade, we've seen a decoupling, right? US equities have had outsized performance in terms of the overall portfolio. They've been the return driver more so the last decade. And diversifiers and bonds have had positive but more modest returns. Now, these decade by decade cycles do tend to repeat themselves. This is not new. And when we think about where we go from here, we do think that all asset is poised to deliver attractive returns, to be that return driver again as a complement to equities, as we saw in the first decade, while still providing that equity diversification and that reflationary, that inflationary bias. And just for a little bit of historical detail on that, if you widen this out and look at US equities versus bonds versus diversifier assets going back prior to the 2000s, you see this pattern tends to repeat. One, in the case of equities today, tends to get relatively stretched in terms of trailing returns and valuations, only to see the reverse come true in the following decade. And the 90s is a really good example of that. Tech-fueled US equity bull market was the predecessor to that underperformance of the 2000s, which has echoes of kind of the environment that we find ourselves in today. And then the last thing I'll make a comment on just high level before diving into more near-term performance and positioning, and especially relevant for this group because you've been with us for 20 years, is that all asset, in terms of those objectives that I mentioned, attractive returns, equity diversification, and inflationary bias, has done much better than more of kind of just a pass it, do it yourself approach, whether that would be kind of a mix of TIPS, commodities, or REITs, or an equal weighted mix of those diversifier assets that we tend to emphasize. You can see here on page 7, we've had higher returns with lower volatility and higher risk-adjusted returns because of that, lower drawdown, lower equity beta, and higher correlation to changes in break-even inflation. And so if we continue that story to the last year, just zeroing in on more recent performance, Q1 was actually a really good example of what we think the future environment is likely, or why the future environment is likely to be much more beneficial for a diversifier-led portfolio like All Asset. You can see on page 14, if you could look across major diversifier asset classes in green, different bond markets in blue, and then equity markets in red, you now see in Q1 the reverse of many of the scenes we've seen over the last decade. Whereas the US equity market led over the last decade, it was the laggard in Q1. S&P down 4, small cap down 10. If you look at diversifier markets, cheaper valuations, tending to do better when US dollar weakens, strategies that do better in inflation, those were that was a ripe environment for those strategies to do well. And we saw that across the board. The other thing I'll note is that we tend to emphasize value within our approach. Value in terms of cheaply valued asset classes, which we'll come back to when we talk about allocations today, but also value within equities. Value is very cheap to growth today. And you saw that despite value having underperformed for much of the last decade, much like US equities have led, you see that value also outperformed in Q1 by a meaningful margin. And so both of these, both the asset class performance, the value bias, were all tailwinds in Q1. What a quarter doesn't make a year, it doesn't make a decade. But when we think about the environment that we're entering, we do think it's one that's more favorable for the strategy. And then if we go back a full year, we can see that 2024, which on page 15 is kind of represented by these hashed bars, was kind of the end of that decade that we saw where U.S. equities led. We saw 2024 was another strong year for U.S. equities. And, you know, pretty much everything else had modestly positive performance, but not nearly to the outsized degree of U.S. equities. And for a strategy that is explicitly designed to diversify away from U.S. equities, you know, it's a high bar for us to have allocations to U.S. equities in the portfolio, particularly when they're richly valued like today. So what we've been emphasizing, these diversifier assets and more recently core bonds, you can see diversifiers on average gave you about 4.5% in 2024. And bonds, high quality bonds, were flat to modestly negative. I'm kind of giving a little bit of a foreshadowing to our allocations, but today we have about 50-60% in diversifiers. We have about 30-40% in bonds. So when you look at our performance in the last quarter in 2024, hopefully it's very much in line with what you'd expect for a diversified led strategy. In April 25 or through April 25 year to date, we're up 3.2%. That fares very well in line with those diversifier assets. That uptick in returns that you got year to date, that you've kind of seen as a complement to some of the drawdown you've seen in U.S. equities, again, down about 4 or 5%, the S&P in Q1. And in 2024, that 4% is just a shade off of what diversifiers gave you. But as I mentioned, it'll dig into a fair bit better than one of our tactical areas of emphasis, which is core bond. When you look back over the longer history, and this kind of goes back to what I mentioned in showing that 4-quadrant chart, showing the attractive returns, as well as the low equity beta, the reflationary bias, you can see that we've delivered attractive returns, 6.4% since inception. But when you look at the year-by-year returns, what you notice is the pattern is very much in line with that decade-by-decade comparison. When diversifiers are in favor and doing well, we've done quite well. When diversifiers are lagging, we'll lag a little bit as well. But it usually means that the equity portion of your portfolio, the growth assets, are doing well. And when we think about where we're headed, we think we're much more likely to have a repeat of the first decade here than a repeat of the second decade, because of where U.S. equity valuations are, because of the yield of the portfolio is quite attractive. And many of the asset classes we're favoring today have singled nearly double-digit returns on a forward-looking basis.
Could you say, in your opinion, what the common factors are in the diversifiers bear markets? What common theme did they each have?
That's a good point. Yeah, so diversifier bear markets, and just to define that, it's when in a given year or period, the equal weight of those 6 diversifying assets are down 10% or more. You know, there isn't necessarily one driving force, but I will say there's kind of 2 environments that happens. One is in a more traditional risk-off market where many asset classes have sold off, but diversifiers maybe not quite as much. So that would be like the great financial crisis in 2008, where U.S. equities were down 40. Anything that had, you know, risk associated with it was down outside of basically core bonds. And so we did a lot better than those asset classes, but the diversifiers were still down. COVID was kind of an environment like that as well. Everything outside of high quality bonds basically sold off. Now, we ended COVID with a strong rally, but during that initial drawdown, diversifiers sold off as well. The 22 environment and the 13 to 15 environment is a little bit of a different environment. These are environments where we saw more broadly rising rates and or kind of a move away or move towards the dollar, basically weakening dollar overall. Those can have knock-on effects for diversifier asset classes as well. TIPS, for example, is still a bond at the end of the day. It's an inflation-adjusted bond, but the significant rise in real yields drove TIPS down in 2022, also about 10% during that period. So that if we had a commonality there, it was a little bit more rising rates and a little bit more of the dollar strength. As we look forward, you know, we would expect actually the opposite of both of those things. Inflation may tick up a little bit in the near term cyclically, but we definitely think from here over the next 12 to 18 months, the path for rates is likely down, not up.
Yes, I know you guys get this question, I think we've asked in the past, but in terms of the appropriate benchmark, like, and now particularly given more of a move into the diversifiers, should we really be benchmarking you against CPI plus the 5 versus, is that appropriate?
Yeah, you were kind of prescient in terms of where I was just about to head as well. So we do have the two benchmarks, right? TIPS is the primary benchmark, CPI plus 5 is a secondary. When you think about longer term return potential for the strategy, the reason we have those two endpoints, I'd say, in terms of the lower bound and upper bound of returns, is that TIPS is an investable asset. It's a real asset in terms of being tied to inflation. But, you know, the strategy is always diversified beyond just fixed income and beyond TIPS. It has always had a diversifier emphasis. So it will tend to have a little bit higher risk and therefore a little bit higher return potential than TIPS. CPI plus 5 is what we hope to achieve over a full cycle. In fact, for much of the history of the fund until we've seen, you know, some more modest return periods more recently, we've been at or above CPI plus 5. We view that as kind of the long-term potential of the strategy, something from today's starting point looking forward, we think is definitely attainable. The challenge with CPI plus 5, it's not investable. You know, it always goes up. There's no volatility. We'd all love to invest in CPI plus 5, but you can't. So we think about that as a lower and upper bound. And when we think about evaluating ourselves in a long period, we want to be at or near as close to CPI plus 5 as we can versus TIPS. And you see since inception, you know, that has been the case. More recent periods, it's been dragged a little bit because CPI has been high and markets have had lower returns. But again, we enter what we think are more normalized environment for inflation and what we think are attractive return potential for many of our asset classes, we can be much closer to that higher CPI plus 5 number. The reason we emphasize diversifiers, and you saw us highlight that in shorter periods, is that we often get the question of, well, you know, are you in the ballpark of what your home base would say or where you tend to emphasize in terms of your asset classes? And that's why we often will show for a quarter or a year, you know, what did diversifiers do? What did bonds do? What did equities do? And it kind of helps orient in a more market-oriented context in terms of what markets were giving and what we were delivering.
I'll get to it later.
You sure?
Yep.
So I know I want to try and make up a little bit of time, so I'll jump into the last section, which is positioning. So I'm going to hit two slides here. One is the forward-looking capital market assumptions for the 16 major asset classes that we use to model the positioning within the portfolio. You can see a few things here. One is that the yellow shading and the green shading, all asset classes outside of US growth are in the green shading. Green shading is positive nominal and positive real returns. Yellow shading is positive nominal but negative real returns. What you don't see is red shading anymore. In fact, at the end of 2021, a number of asset classes were in the red shaded area or the yellow shaded area. So in general, over the last few years, our return forecasts for many asset classes, particularly diversifiers and bonds, have improved pretty meaningfully. That goes to my point about why we think we can achieve attractive, you know, CPI plus 5 like returns over the next 5 to 10 years. Because on just a passive, equally weighted basis, diversifiers alone are getting you kind of in that 7-ish% range. That's before the alpha of underlying PIMCO funds. That's before any tactical shifts across the portfolio. One other thing I'll note here is the blues on the left-hand side, high quality bonds giving you 5% passive return forecast, very much in line with starting yields. You add another potential percent on that for actively managed bond strategies. And it's a very healthy return potential for a diversifying asset. You know, 2022 was a very unique environment in terms of how significantly and how rapidly rates rose, bringing down the returns of all asset classes, bonds, and risk assets. Looking forward, you're getting a very attractive return potential just from the yield alone. And like I said, we think maybe not aggressively, but at the minimum, modestly, we think rates will actually come down from here. So a very favorable defensive position we have in the portfolio today. And then at the opposite end of the spectrum, you see some quite attractive, albeit with some volatility, return potential from things like EM equities, REITs, commodities as well from a diversifier and inflation perspective. And what you'll notice is US equity is much more modest. Now, not outright negative, but US equity is at kind of 3-4%. And all the asset classes here, I'll note, how do we get to the CMAs? Well, it's a combination of the yield on the strategy, so dividend yield for equities or yield to maturity on bonds, the growth in that yield, so real earnings growth in the case of equities, and then valuation change, basically a movement towards long-term average valuation. So even from a Shiller PE or a cyclically adjusted PE of over 30, you still have a positive return from US equities. You just think that many of these other asset classes are poised for much higher returns looking forward. And then what does that mean from a positioning perspective today? This is the last slide I just want to highlight, and then happy to answer questions or go deeper on any of these different areas. This shows that longer term history of our allocations over time. The green, again, are diversifiers. The blue are bonds. The reds are developed equities, US and developed ex-US equities. So you do see that the strategy tends to have diversifiers in focus because of those ability to achieve attractive returns at various times, but with diversifying properties, diversifying to equities and a reflationary bias, but that we do move around within diversifiers and we move around across asset classes. We're not fast twitch, right? We're not like trading in and out on a daily or weekly basis. We tend to leg in positions over months and quarters as asset classes get cheaper, unless you see more dramatic moves in markets like a COVID or a great financial crisis. Now, our positioning today, you can see, is emphasizing short core and long duration bonds, the blues, and a diversified mix of diversifiers leaning into some of these return-seeking diversifiers we saw on the CMA page, emerging market equities, REITs, EM debt, and commodities where we find attractive long-term returns. We have very minimal US equity exposure. And like I mentioned earlier, because we seek to have a low equity beta or low correlation equities, it's a high bar for us to have US equities. In fact, a large allocation would be something like the aftermath of 01, 02, and where we had 20% as a very high level. You know, single digits are by design here. When you put that together, it's a very attractive yield on the portfolio. So this yield in the upper left of 7.3%, that's the yield to maturity on bond allocations plus the dividend yield on equities. And if we think about this positioning relative to where we could see the market head over the next 12 months, we think we're well positioned for kind of two environments that could come. One would be maybe just kind of a continued muddle through, or basically the current environment that we've seen. Range bound on rates, albeit volatile within that range. Equity markets that are range bound but relatively more volatile. You know, you're not necessarily seeing a massive shift in terms of cross asset returns or things that are very quick to kind of return to normalized levels. Well, in that environment, you know, we have a very attractive yield to basically clip the coupon and anchor our return potential in that 7% range. And should we get a little bit of price appreciation, even if it's modest, that would add on top of that yield. Now, what about an environment where you see a more significant risk off or significant sell-off and more sustained, right? We saw a US equity sell-off that was, you know, call it 4 or 5 weeks that we now have fully recovered. But if you see a more sustained sell-off, in that environment, we have a lot of dry powder here that we think would do well. We would expect rates to rally. And if you saw the 10-year break through 3.5%, start heading towards 3%, which would probably be likely in a more sustained, broader risk-off environment, these greens and red positions, the risk positions in the portfolio, return-seeking, would be hit, but likely not as much as the broader market. We tend to focus on things that are already cheap or are a little bit more value-oriented. And it would allow us the opportunity to redeploy a lot of this dry powder into some of these newly cheap assets. This has happened in the GFC. This happened during COVID. I'm not saying it's going to necessarily be that kind of environment again, but again, should we get a more volatile environment, that's where a more defensive positioning we think can also pay off in the long run. We can use it to re-risk and then see more of the upside when markets rally. So let me pause there. Yeah, sorry.
What does your stress testing for the dollar show? What's your sensitivity to the portfolio to the dollar? If we get this if we all of a sudden are the dollar no longer a place to be?
So the good news is this is a portfolio that tends to do well when the dollar weakens. What we show here is US dollar performance in dark blue, which, you know, as many have kind of focused on, tends to come in bigger cycles. We've had a pretty strong strengthening. So when the dark blue line goes down, it means dollar strength. And then the light blue line is when our favored markets, diversifiers, their relative performance versus kind of a traditional 60-40 or more US equity led. What it shows is that when dollar weakens, our strategies tend to do better. When dollars strengthen on a relative basis. When dollars strengthen, our strategies tend to do a little bit more poorly. And so that's for two reasons. One is we hold probably more non-dollar assets than you know, many traditional portfolios. We have developed ex-US equities, EM equities that are unhedged. That's about 20% of the portfolio. And then probably another 5 to 10%, whether through locally denominated EM debt or just active positions in the underlying fund. So about 30%, let's say, non-US dollar based. And then the other thing you tend to notice is we you know, have an emphasis outside of the US and a little bit more on inflation, whether direct inflation sensitive or indirectly inflation sensitive assets. And when the dollar weakens, that tends to strengthen the positioning and returns of inflation sensitive assets, as well as non-US assets as well. So that's actually something you would be rooting for in this portfolio, right? A weakening dollar tends to lead to better, at least relative and typically absolute performance for the all asset fund.
Could you share what your dollars stress test show? You know, down 5%, 10%, 15% is, I'm sure you run those numbers.
Yeah, so I can speak in high levels. I can't put exact numbers on a mutual fund. Like regulatory, I can't say like, you know, if this happens, then, you know, this performance will occur. I think the bigger question is if the dollar weakens, what is going on with interest rates, right? And equities more broadly, right? And which equities and which interest rates, right? So if we were to see kind of 5-10% weakening of the dollar, you know, unlikely that is, if it occurs like kind of orderly and not like in a disorderly unwind, what that likely would mean is, you know, overall weakening would probably lead to, you know, a sell-off in, it's probably tied in today's environment like we saw during the tariff discussions with a sell-off in US equities and a sell-off modestly in rates. But those would be kind of more benign environments, actually not unlike probably what we saw in April. And if April is kind of a microcosm here, US equities were down, you know, 10 to 15% at their peak to trough. US rates actually relatively range bound. You know, 10-year yields went from about 4% to about 4.5%. They did it very rapidly, but they did it in kind of a range bound rate. We've been in that 3.75 to 4.75 range on the 10-year now for about 2.5 years. In that environment, we kind of know already what all asset did. It was modestly positive. Why? Because our non-US assets rallied. International equities were up 11%. You know, many diversifier assets, again, that's an environment that we do quite well in. In a more sustained sell-off of the dollar, it would, you know, that's probably more telltale of something breaking a little bit more in the system, maybe an extension of what we saw that many were worried about with the sell-off we saw in April. Likely you'd see some sympathy sell-off for other risk assets outside of US assets, but US assets maybe being hit harder. So that would mean us doing better on a relative basis, but still potentially in negative territory because, you know, you'd see many asset classes sell off double digits. Again, in that environment, if you look through that kind of crisis and see what could happen in terms of recovery, that would offer us the opportunity to, like we did in GFC, like we did in COVID, take some of those bond holdings and then buy some of those assets that are now at more distressed prices.
Thank you.
Justin, on page 20, you've got emerging market equities in the upper right-hand quadrant. You know, what's your view on China in that mix?
So, you know, China, yeah, China is, it's a tougher one. I think overall we see, you know, generally slowing growth and the bigger obstacles with China is that it's much more policy driven, right, in terms of what to expect between US and Chinese relations. The good news is from an EM equity perspective, you know, the index is much more broad than China overall. And this is an actively managed strategy, you know, more value oriented, managed by research affiliates. And so when you think about Chinese exposure, it actually, you know, tends to move with valuation. So really when you see any modest or, you know, meaningful, I'll call it in the, you know, low double digit allocation to China, it's because there's, you know, attractive valuations, but in environments we don't favor China as much. You can see it down in kind of the low single digit. And Chinese exposure overall in this portfolio, going back over the last, you know, several years has been low single digit, very minimal overall direct China exposure.
In looking at how diversified your portfolio is in terms of different asset classes and different instruments, what areas of risk actually do drive like negative performance? I mean, what are your risk areas and what scenarios are actually risky given that portfolio?
So I would say that, you know, when I kind of talk about risk assets selling off in tandem, I'm typically talking about developed ex-US equities, which aren't actually diversified, but there's a meaningful allocation there, EM equities and REITs, and to a lesser extent, EM debt and credit strategies. I kind of take commodities out of it because commodities are very binary. You can get a 2022 where commodities are volatile, but they're the one strategy that's up, or you can get more of a growth miss where commodities are down as well. So in these environments, you know, these would be the asset classes, the ones I just named, that would sell off in sympathy. But, you know, it doesn't necessarily mean that, oh, US equities sell off and EM equities are automatically down higher, right? In fact, Q1 was a good example where that's, you know, not actually the case. EM equities were actually up, you know, 3% in Q1 when US equities were down 4.25%. So, you know, this is a particularly strong period for diversifiers and core and long maturity bonds. When you extended this into April, before you got the round trip rebound, and so this picture year to date looks actually very similar to it does here, outside of US equities now being more positive. You saw some of these dip a little bit negative, right, in over that period, but then rebound again on a relative basis, still doing much better than US equities, but those are the ones that would move in sympathy.
On your commodities, your first quarter, your performance was quite good. In fact, it was, I think, the best performing of your group. But I'm just curious because the CRB, Commodity Research Bureau Index, I think was down at the end of the first quarter. And so was the Goldman Sachs index, and the LME index was basically unchanged. So I was just curious as to what you had in the portfolio that performed so well.
Sure. So this is just Q1 data on page 15, and for reference, the commodity index we're referencing here is the Bloomberg Commodity Index. So, you know, when that is up and we hold a position, that obviously helps, though I will note, you know, commodities here were on page 17, a nice contributor, both 2024 and year to date. Again, this is another area where we have actively managed commodity positions. So there are times when actually the benchmark could be for commodities could be flat to down and we're up, or we could do even better if the active management works, or we're slightly worse. But usually it's around kind of what the benchmark itself has done. And so the Bloomberg index specifically, at least in March, was up. In April, there was some weakness, right? So if you were looking at year to date numbers, it might not look as rosy as it does through March.
And in your bond portfolio, what is the average grade of the bonds outside of treasuries, but within the treasuries, what is your duration?
So good question. The overall duration of the portfolio is 4.5 years. So that gives you kind of the most blunt estimate of if yields increase 100 basis points or decrease 100 basis points, everything else held constant, what might happen to the portfolio. You can see if you dig a layer deeper here, much of that is focused at the front and intermediate portion of the curve, We do hold some long duration bonds, which obviously pack a bigger punch because they have more duration overall. But both PIMCO and research affiliates find the best risk-adjusted returns at kind of the front and intermediate portion of the curve today. Basically, the best risk-adjusted potential and where we think yields will fall the most, you know, going forward over the kind of our cyclical horizon. The long end can be helpful and in extreme market environments can diversify quite well, but we have some hesitations there given, you know, fiscal policy and kind of worries about long-term debt sustainability. That's going to be felt most at the long end of the curve. That's why we focus more on the intermediate and front end. And the average credit quality in the portfolio is investment grade and actually quite high. Many of the underlying strategies themselves are actively managed, as I mentioned, but tilting towards, you know, high quality fixed income in this environment because, you know, spreads are relatively tight. We don't find it all that necessarily prudent to take a lot of credit risk in this environment. And so the bond positions that you see are particularly high quality.
And do you have any CLOs?
To the extent we have CLOs, typically they're pretty modest overall active positions with the underlying bond portfolio. And usually the kind of like AAA, the highest quality overall. And let me just give you, I can give you actually the average credit rating real quick. Average credit quality is AA minus. So that just gives you kind of a sense of the bonds we hold are very high in quality.
Well, you know, the thing is with the CLOs, do they remind you of, you know, like mortgage-backed securities, because they package things and make them AAA. And also, when they used to have municipal bond insurance and all of a sudden they were AAA. And now the CLOs are packaging stuff and deciding they're AAA. Do you
Yeah,
there's
I
risk
think
in that?
so. I will say, and Eric, please also offer your thoughts too here too. PIMCO, you know, a lot of that CLO issuance, you know, is kind of funneling into an area that PIMCO finds probably, you know, not all that attractive today in terms of where the lower tranches of CLOs in particular are used to finance a lot of the rise kind of in private credit, middle market lending and things like that. You know, we've been pretty vocal that, you know, you need to proceed a little bit with caution as you move down kind of into those territories. And that's why, you know, relative to many other peers and in many of our portfolios, to the extent you find any of those kind of allocations, it's not the lower quality, it's the highest of quality, shorter dated, that you'll tend to find with us. So it's a little bit different than I'd say non-agencies in the sense that, you know, at that time, in kind of in 07, 08, we found probably even worse fundamentals and worry about non-agencies kind of pre-crisis. The securitization obviously was kind of exacerbating that. Here, I think it's more mild in both directions, but, you know, yes, that is something as a firm that we're kind of keeping an eye on, you know, overall, and that's something that in these portfolios, the underlying funds and all asset, you'll find very little of.
And do you have much private credit?
So with private credit, I think the question there is, how do you define it, and specifically where you know, there's very different kind of subsegments in that. So middle market lending, direct middle market lending, we kind of find is a relatively saturated market where spreads have been bid pretty tight. But if you look at asset-backed finance and kind of broaden that definition, we find a lot more opportunities in a good way, because secularly, a lot of that is moving off of bank balance sheets and needs to find a home in terms of investment capital.
And just to clarify, do you mean in this strategy or more broadly about private
Well,
credit?
you know, you own debt, so I don't know whether, like liquid alternatives.
Oh,
What are
sorry.
liquid alternatives?
Yeah.
Things like that.
Thank you for clarifying, Eric. Yeah, all the underlying funds that we hold are 40 Act mutual funds. We don't hold kind of private credit or anything with a lockup. Every underlying fund we hold is a daily liquid mutual fund. And that includes the liquid alternatives. So the liquid alternatives include a managed future strategy, an equity market neutral, and equity long short strategies, but ones that are daily liquid. So nothing with a lockup, nothing with less liquid assets that they hold.
What, on the bottom of 41, the little gray multi-exposure funds?
Yes, so those funds are also 40X funds. They're for the exclusive use of all asset. And the reason we have those funds is for trading efficiency. So I think we may have taken it out of this deck, but you'll notice with a lot of our equity strategies, as well as our commodity strategies, we have what we call our plus funds. So we get exposure to, let's say, the S&P 500 through futures and swaps and collateralize that position with a high quality, low duration bond portfolio. We've been doing this for 30 plus years. That has been a very strong source of kind of consistent alpha for those strategies. But when the all asset fund wants to trade, and we did this for many, many years until about 2020, we'll sell, let's say, the Stocks Plus International Fund, and we'll buy, let's say, the Commodity Real Return Fund. Well, every time we do that, we have to take money from one fund and move it to another. There's a more efficient way to do that, which is to set up a fund for the exclusive use of all asset that can get exposure to all those different markets, let's say S&P and commodities as an example, where we don't have to sell out of one fund to buy another fund. We can just change the exposure within the existing fund that only all asset can own. So that's proven very beneficial to allow for efficient trading. So we're not, selling out of one fund, buying another fund. It's just easy for us to kind of change the overall exposure within those multi-exposure funds, if that makes sense.
Yeah, okay, so it's not like the performance from there is additive to like the return stream, it's just a resource to create more efficient trading for the mutual fund itself.
Exactly, there's no leverage in these funds, so if you give us $100.
That's kind of my question,
Yeah.
I was like, it looks like leverage, but I just wanted to make sure, okay.
Yeah, this is a call out. So it's saying, the pieces, the bottom under the gray are each piece of it is found somewhere in one of these allocations. So they have multi-exposure. So I'll give my S&P and commodity example. Let's say we had 10% S&P, 10% commodity. We're going to show that 10% S&P under, the US equity line. We'll show that commodity line under the commodity line. And the simple way of thinking about it is you give us $100, we're going to buy $100 of 40X mutual fund. Full stop.
Basically, there's a lot going on in Washington right now, but what's your projection for the 10-year yield in, let's say, 3 to 5 years from now?
So it would be lower. Kind of modest over that full cycle. So if I think about, the front end first, which kind of, you think about where front end yields are going to go, both research affiliates and PIMCO, you can see kind of over the longer horizon, see the kind of the T-bill or the front end of the curve kind of settling around 3-ish%. So obviously that's about 1% lower on the front end. We would expect kind of an upwardly sloping yield curve. And so where we've been kind of bouncing around 4.5% actually like today, we would expect that to come in maybe about 100 basis points lower, 3 to 5 year horizon. Obviously that could be a uncertain path, right? Because if you get a true risk off environment, Fed brings yields down to 1 or 2%, 10 years not going to be at 3.5, 4, it's going to be below that. But that, if you think about kind of a more normalized landing spot over kind of that secular horizon, kind of that, front end 3-ish, kind of intermediate 3.5.
Any other questions?
I'm good.
Well, you were right, definitely a sharp group, but I think.
I can say that to everyone.
Definitely not. No, but we appreciate the time, the opportunity. Thank you for, time to present. And then, of course, if any questions come up, we are happy to answer any follow-ups.
Good.
Hey, since we've been with you 20 years, don't you think you should give us a break on fees?
It's a fair question. Unfortunately, we're not allowed to do that in a mutual fund format, but It's a fair question.
That's a good way to respond to it.
Yeah.
Guess so.
We'd love to.
Our hands are tied.
Favorite questions?
The other question, if you thought about creating a collective trust. So you could do that.
So we, the short answer is we have a CIT. It's actually more expensive. And the reason for that is, and maybe it comes back to the institutional share class that you own is the lowest fee that we offer. And actually to perform the administrative services on top of just owning, basically the CIT just owns the all asset mutual fund, we charge a few extra basis points. We've looked at exploring it. It goes back to a long story short of kind of our hands are tied on that front as well.
Okay. Can't do
Real
it.
hands are tied. We've had that one before.
Hands and feet are tied, okay, good. All right, thank you
All
guys.
right, thank you
Thank
very
you.
much.
Thanks again.
Thanks, everyone.
Appreciate it. Thanks for coming
Have a
out.
good night.
Good night. Thank you.
Yeah. Do it, that could be better.
What happens with the other three? There's some stuff that's unhedged. But, and we're not supposed to have things that are, but we don't have it anymore.
The only maybe question I have for the group related is with respect to the benchmark, and I asked the question specifically, so in our reports, we're just showing the tips, the 1 to 10 year.
Yeah.
And I'm curious whether the group would want to consider adding that CPI +5 as a secondary benchmark. So like, if you look at their report, they're using it there, and I think that's actually more fair.
Sure, why not?
Why not, yeah.
It can't hurt, right? Because I think over the longer term, that's the more appropriate, especially if they're gonna load onto the diversifiers.
Yeah.
Like the other seems like a pretty easy bogey to beat at the moment, right?
Yeah, they've been doing pretty well against it.
Yeah,
Yeah.
so
So what's their allocation range
in terms of,
in terms of us? Right now, we're at 7%, target 6%. What's our range?
so you're saying like, as far as like an asset allocation? what's the range?
Yeah.
Oh, sorry,
No problem, no. Sorry for not being clear.
no. It's a good question. I don't know if we have it in this report or if I don't know it off the top of my head. Does it say, like, I could look at IPS maybe,
Yeah.
as far as real assets goes, David?
That's probably like the ETF or somewhere. Yeah.
I'm not even on the Wi-Fi.
So, where you looking at that? So the CPI +5, right? It underperformed the last 6 months, year, 3 years. After fees, it was 1.85%, and CPI +5 was 8.6%. So it does seem like,
They're
Yeah.
falling short.
I mean, do you want to add that as, I mean, they're not making CPI +5.
Agreed, and I'm saying, cause I think to me, it's a little bit misleading. When you look at like particularly the 5-year number where they're,
Right.
almost 600 and I'm like, well, that's not actually,
Well, the point he made is that the CPI +5 is
it's not real.
well, but it's also, he called them up versus the tips. It was like an upper lower bound.
Right.
We should be somewhere in there. And so just to help bound the what we're seeing, I think it'd be a fine idea. It
Yeah,
should be somewhere in between there, is what they're saying.
Right, but
What do they say in their,
The number is
in
4
their,
as well.
when we signed up for them, were they using tips or this CPI +5? Do we know? Have they evolved on this over?
they've evolved on it, I think, because they got pushback initially, like this is going way back when.
Yeah.
From the institutional side, I mean, they have a
Too
big,
easy?
yeah, they have a big retail presence, right? which is probably why the CIT doesn't make sense, because there's so many assets in the mutual fund, like the lowest share class there, they'd have to build they could do it, they'd have to build the assets in the CIT to get to offset the admin where it's competitive with the mutual fund side. It's just, you know, what comes first kind of thing. But go ahead. Yeah, but the point
Well,
being is,
One of the things, when we have a discussion like this, because they can hear it, we should go into executive session.
sure.
So could we do that? Should somebody?
Do you wanna do that now?
Later in the,
Why don't we do it later? If we
we'll
get it?
do it later, because we already got a bunch of stuff. for-
Real assets, the target is 6% with a range of 4 to 12.
Yeah.
Okay, so we're fine,
We're pretty much, yeah,
yeah. Well, we're on the low end,
Midpoint.
Mhm.
Yeah.
Probably, as well.
well, we're at 7% right now, roughly.
Yeah.
So we're about right.
Yeah.
We're low.
yeah. All right, so we could add that secondarily and use them as a range.
Oh, now we're gonna go on to performance report, I mean, okay,
Yeah.
That number, when those key stats, that gross yield 7.31%. With a volatility of 9.3%, it's pretty impressive.
If they can hit it,
They can hit it, right? I guess they're hitting it so far.
yeah. It depends on the period. Again, over the last 7 years, they haven't hit it.
They're gonna hit that.
So, okay. We'll try to make this somewhat quick on the performance side of things, but, we're looking at March now. This was pre-Liberation Day.
Yeah.
So, yes.
Agree, maybe I
But just, yeah,
didn't think this through.
equities had already started to retreat in March. If people remember, there was a lot of the initial flurry of headlines on the tariff, so people started to get a little nervous, you know, in terms of sentiment. You know,
Yippee, I think is the term.
yippee is a good term. Not to be confused with hippie and the Deading Company. But, you know, concerns around growth, inflation. I think the irony is that the US economy was actually still doing pretty well. And even now, like you look at some of the underlying numbers, headline CPI, employment data, they were all somewhat stable. Equities is where we really started to see things sell off in March. US stocks took the biggest hit. Large cap was down 5.5%. And the majority of that was in growth. So value was 2.8, growth was down almost 8.5% in March. Small caps were down 6. Outside the US, the weakness actually provided a bit of tailwind, and this kind of ties into the mega caps, which had been a big headwind to international side of things selling off. It also had to do with the dollar going down, which has been a headwind for decades at this point to the international side of things. So we saw modest returns of about 0.5% to 1% in both developed as well as EM equity. And then as a result of everything that unfolded, we've now seen a lot of international companies almost like being reinvigorated, you know, think German defense companies, things of that nature. So it'll be interesting to see whether or not it's a secular shift going forward. Fed kept rates unchanged. You know, Trump was calling them a loser, but they actually look pretty smart now in the grand scheme of things. And fixed income returns, they were mixed, you know, depending, like there was some steepening in the treasury yield curve. The 10-year was flat. We did see the beginning of what continued into April and even today, like a widening in terms of the spreads. And then commodities, actually, they had a pretty good March. They were up about 4 or 5%. So that's just at a high level. In terms of the portfolio itself, maybe no surprise, it was a down month. And you know, a little bit challenging across the board. I was looking at quarter to date, so I think first quarter numbers for some of the managers. I thought maybe that might be a little more interesting than just March itself, just to give some perspective. I mean, we can see the fiscal year to date, but that it feels like so much has changed in the last 9 months or 9 days. But just for perspective, principal year to date, so they actually They were down 14 versus 10 for the Russell 2500 growth. They're still ahead on the 3-year, but challenging environment for them. Conversely, LSV on the value side, they're down 6% year to date, but they outperformed the Russell 2000 value by 180 basis points. Very deep value manager. On the international side of things, Silchester was up 5.8%. They're more value manager versus 6.9 for the MSCI EV. Contrast that with Walter Scott, who was actually down 0.5% year to date, again, versus the MSCI EV of 6.9. So really challenging one for them. They are on the growth side, value outperformed. They also talked about the fact that they lacked exposure to aerospace, defense, banks, all of which ran in Europe in particular. And then fixed income, I did note that I had it written down here, PGIM core bond, they were up 2.5% for the first quarter. The ag was about 2.7. TCW was up about 3.1. A lot of that, the duration for them that we've talked about at length actually paid off in the first quarter, given the environment. So again, perspective on the first 3 months, things changed in April, things have since changed in May, but I think it's always interesting and educational to see how people performed in these kind of inflection points as a go forward barometer of what maybe we should expect. Questions on anything?
Chisholm, what about private equity? Are you getting money from them or
Oh, from,
from Pantheon?
yeah, we've been receiving the, distribution from them
220,000?
around there.
Yeah. Which is something, because not a lot of private equity distributions are taking place.
Mhm.
Way to go, though.
Yep.
Yeah.
That's only, well, that's the thing. There's a lot of
Yeah.
the GPs keep,
1%.
a lot of GPs just keep bumping. A lot of people expected more activity this year with Trump policy, and it's been the reverse, so. Settle in.
So they're what, 20 million there, right?
Yeah.
We have put money into them in 10 years.
Yeah.
These were 10-year funds, right? Sure.
You could move the
Up
other.
Okay.
Okay,
And that's it from our side as far as the
any questions?
investment.
If there are no other questions, we are going to go into executive session.
Okay.
I'll make sure we're recording.
Okay,
Okay,
Mr. Chairman, I move that we approve the pension application of Richard Darling commencing on January 1st, 2025, and not at any earlier date that he requested.
is there a second for that?
I'll second that.
Any discussion? All in favor?
Aye.
Opposed?
Aye.
Passes unanimous. We can vote.
Just a point of record, because today is the 14th and pension payments are made on the 15th and they already have to be processed. The first pension payment will be paid on June 15th, but it will be retroactive, so it will include January through June. So I just want, just because the way it needs to be processed, it needs to be processed the Friday before, and obviously tomorrow is the pension pay date. So I just wanted to let everyone know that.
If he accepts that and cashes it, does he get a check? Isn't that kind of acknowledgement that he's agreed to the January date?
So I'm not sure, if he elected, I don't have his pension application in front of me. Sometimes they elect direct deposit and so they don't get a check. So it may be a direct deposit. I'm not sure. I can check on that.
I'm just curious.
He did send an email that he
Not argue against it, but-
put it in, and I just let him know that we were going back in, so I didn't know if he was going to join. But he is not.
Who was on there? Just dropped.
oh, there's a hand raised. Oh, and then they just, I'm not sure if that
Oh,
could be.
yeah.
It's back.
And right, that may be him, so we may want.
Do you want to allow him to talk?
Well, we already asked for public comment. No. I mean, we earlier on,
You can listen, just say,
yeah, if you want,
yeah,
no, fine,
Do you want to? Okay.
sure.
just do what you have to say.
Oh, I'm sorry. I asked him to mute. Okay. Well,
You asked them to talk, is that?
yeah, I did. Let's see.
You want to click on ask to unmute?
Yeah. Okay, let's see if that works. Usually there's a button here that I can move them
Yeah.
to be invited as a panelist, but I do not see that button because this is
He
the,
should be able to hear
He
it, so
should
we
hear
can
it.
ask,
Right.
we can ask him.
oh, right here, he's right here,
Yeah.
right? Is that,
Absolutely.
okay. Could you unmute? I think, is it press star? Yeah. He could hear us.
Can you unmute him yourself?
No.
No, the person has to unmute on their phone
Yeah.
and able to,
Yeah.
Well, he should be able to hear you, right, to do that?
Right.
I don't see any way for us to unmute him.
yeah. I could only ask.
Text that.
Send a message, sometimes you can.
Oh.
I'm just not sure he knows how, is I guess the problem.
Right, I don't
I'm trying
know.
to see if I can Google.
Hold on, let me,
Go to-
I'm gonna call somebody or IT.
Oh. I think he's now joining in. I just sent him a text, but it looks like he may be joining as a participant as well. And it does look like he's a panelist, so he should be able to talk now. I'm not sure.
You hear me?
Here he is. Yep, we can hear him now. Okay.
Let me turn off the phone because I wasn't able to join on the computer. Okay, thank you for your time and consideration. I'm sorry, the phone is still on.
We can hear you, sorry.
Yeah, good. Just a quick question, the legal opinion, did that come from Corp Counsel or from another attorney?
So, Corporation Counsel is now a contracted service. So we use Bertram Moses as our law firm. So it came from an attorney from that organization that specializes in employment law and related matters.
Okay. All right, and if I understand the pension document correctly, there's a 60-day period to appeal?
Let me.
No, I mean, you don't have to answer that right now. It is in the document. And could I request a copy of the opinion as well?
It's attorney-client privilege. I'll have to get permission. I'm not sure that I'm able to share that. I will ask, it's marked as attorney-client privilege. It was not, because that's why we went into executive session. It's not part of the public packet.
Okay. All right, that's all.
Mr. Darling, did you hear about timing? And so that you will receive January through June on June 15th because of the way the pension needs to be processed?
Yeah, I heard that.
I just wanted to make sure that you heard that. I didn't know if you were on when we discussed.
Yeah, I was on the phone.
Okay,
All right. Have a good evening.
thank you.
Thank you.
Since it's gonna be before 8 o'clock, is there, you gonna the talk or else we could say, is there a motion to adjourn?
I move to
There
adjourn.
you go. Have a
Yeah,
motion.
okay. Yeah, let Charlie do second because he hasn't been in a couple of meetings here.
Second.
Second.
There you go, second.
All in favor?
Aye.
Opposed? Thank you very much.
Thank you.
All right, have a good night, everybody.
night.
Dates for you.